On December 3rd, 2024, something happened that JPMorgan Chase has spent 15 years trying to avoid. They received delivery notices for 5.2 million ounces of physical silver, contracts that couldn't be rolled, couldn't be cash settled, and couldn't be ignored. This wasn't supposed to happen. The entire COMEX silver market is built on one fundamental assumption, that you'll take the cash instead of the metal. But at $59 per ounce, that assumption just died. And JPMorgan is now facing a trap they engineered themselves. Think about how futures contracts normally work in our financial system. You and I, we see these markets as places where real commodities get bought and sold, right? But here's what should grab your attention. According to COMEX data, 95% of all silver futures contracts historically settle in cash, not metal, cash. That means for every 100 paper contracts promising silver delivery, only 5 people actually demand the physical bars. The other 95 just take their profit or loss in dollars and walk away. This creates an incredibly convenient situation for the banks running these exchanges. If only 5 out of every 100 contracts need real metal, then theoretically you could sell 100 paper claims backed by just 5 ounces of actual silver sitting in a vault somewhere. It's fractional reserve banking applied to precious metals. You promise delivery to everyone, knowing statistically that almost nobody will actually show up to collect. And for decades, this system worked perfectly because the assumption held true. But JPMorgan didn't just participate in this system, they dominated it. Between 2010 and 2020, they positioned themselves as the single largest vault operator on the COMEX exchange. Why would the biggest bank in America want to run warehouses full of silver bars? Because controlling the vaults meant controlling the delivery process itself. When those rare moments came where someone actually demanded physical metal, JPMorgan could simply shuffle inventory between their own eligible and registered vault categories, creating the appearance of abundant supply without actually sourcing new metal from the market. Here's where the story gets interesting, though. In June 2021, something changed in the global banking system that most people never heard about. The Basel III international banking regulations went into effect across Europe, with phased implementation reaching our markets over the following years. Buried in those regulatory updates was a technical classification change that seems boring until you understand what it actually does. Unallocated precious metals, that's the fancy term for paper claims on metal that isn't specifically earmarked for you, got reclassified from Tier 1 assets to Tier 3 assets. What does that mean in plain English? Banks can no longer count paper metal promises as high-quality assets on their balance sheets. If you're holding a derivative position that promises silver delivery, you now need to back it with actual physical metal, not just another paper contract. The fractional reserve game just got shut down by international banking law. No press releases, no dramatic announcements, just a regulatory footnote that made the old manipulation strategy mathematically impossible to continue. Now, you might be wondering why this matters right now, specifically at $59 per ounce. Pop quiz. What happens when silver prices cross certain threshold levels that change the fundamental economics of who's buying and who's selling? At $58.50, according to mining industry data, silver production becomes profitable enough that major producers like First Majestic Silver and Pan American Silver started making a calculated decision. Instead of delivering their newly mined silver into COMEX warehouses at exchange prices, they began selling directly to industrial buyers at premium prices. Why feed the exchange that's been suppressing your product's value for years when manufacturers are willing to pay more for guaranteed supply? Then there's the China factor that most American investors don't fully appreciate. The Shanghai Gold Exchange, which is where physical metal actually trades in Asia, saw silver prices hit the equivalent of $62 in yuan terms during November. That price gap created what traders call an arbitrage opportunity. Buy silver from COMEX warehouses at $59, ship it to Shanghai, sell it for $62. Simple geography and mathematics. But here's the consequence. COMEX inventory dropped by 4.1 million ounces in November alone, according to exchange data, as metal flowed east to capture that spread. But the real pressure at $59 comes from an entirely different category of buyer, industrial users. We're talking about solar panel manufacturers, electronics companies, and electric vehicle producers who need silver for actual production, not speculation. These companies have supply chain managers whose job is to secure materials for 2025 manufacturing contracts. When silver crosses $59, it triggers something close to panic in procurement departments because this price level signals potential shortage conditions ahead. Think about what that means from their perspective. You're responsible for sourcing 10 million ounces of silver for your company's solar panel production line next year. Your entire manufacturing schedule depends on that material arriving on time. At $58, you might wait and hope for a price pullback. At $59, you stop hoping and start panic buying because the cost of missing production targets far exceeds the cost of paying a premium for guaranteed metal. These industrial buyers, the ones who actually need physical delivery, just remove themselves from being the exit liquidity that paper traders normally rely on. So here's the trap that JPMorgan built for themselves, and it's pure mathematics with no escape routes. They accumulated 947 million ounces of paper short positions between 2008 and 2020, according to CFTC Commitment of Traders data. That's nearly 1 billion ounces of promises to deliver silver. The strategy was brilliant in its simplicity. Take the short side of futures contracts, collect premiums, and almost never actually deliver metal because 95% settle in cash. Control the vaults, control the game, repeat for 15 years. But Basel III changed the equation by requiring physical backing for those paper positions. Their vault inventory, which peaked at 47 million ounces in early 2023, has collapsed to just 8.9 million ounces today. That's an 81% depletion rate in less than 2 years. And at $59 per ounce, delivery demands are accelerating because all three pressure points, mining supply withholding, Asian arbitrage, and industrial panic buying, are hitting simultaneously. Every ounce that JPMorgan delivers to satisfy one contract depletes the physical inventory backing their remaining paper positions. Every ounce they refuse to deliver proves the market is fraudulent and triggers more delivery demands from contract holders who realize the emperor has no clothes. They can't win, they can't escape, and the clock is ticking because registered inventory across all COMEX vaults just hit 28 million ounces, enough to cover just 8.4 days of current delivery demand rates. Let me put this in perspective for you. Imagine you wrote 100 checks promising to pay someone $1,000 each. You only keep $5,000 in your bank account because historically only 5 people ever cash their checks. Everyone else just trades the checks back and forth as if they're money themselves. But then the rules change. The bank tells you that you need to have actual money backing every check you wrote, and suddenly people start showing up to cash those checks because they realize you might not be good for it. How long before your account is empty and you're facing bounce check fees? That's JPMorgan's situation right now, except we're talking about billions of dollars and a commodity that the entire modern economy depends on. This is not a conspiracy theory. This is not speculation. This is mathematics playing out in vault inventory reports, delivery notices, and regulatory filings. And the math says JPMorgan is trapped in a position they can't exit without either admitting fraud or depleting their physical backing entirely. The delivery notice they received on December 3rd for 5.2 million ounces, that's not the end of the story. That's just the first domino falling in a chain reaction that could reshape the entire precious metals market. Because once the market realizes that the biggest bank in America can't deliver the silver they promised, everything changes. And it's already started. Now, I know what you're thinking. This sounds like another conspiracy theory about big banks manipulating markets, right? Except this time, we have the receipts. And not just any receipts, official government data, regulatory settlement documents, and JPMorgan's own SEC filings that tell a story so clear that even the people doing the manipulation couldn't hide it. Let's start with the CFTC Commitment of Traders reports. These are public documents that the Commodity Futures Trading Commission releases every week, showing who holds what positions in every major commodity market. Think of it as a scoreboard that tells you which teams are betting up and which teams are betting down. For over a decade, these reports showed something that should have triggered alarm bells at every regulatory agency in our country. JPMorgan Chase held a concentrated short position averaging 32% of the entire COMEX silver market between 2010 and 2024. Let me repeat that for emphasis. One single bank controlled nearly one-third of all short positions in the American silver market. In March 2020, their position peaked at 40,550 contracts, which represents 202 million ounces of silver they had promised to deliver if called upon. To put that in perspective, that's more silver than most mining companies produce in 5 years. Here's where it gets really interesting, though. The CFTC has position limit rules specifically designed to prevent this exact scenario. These rules cap how large any single entity's position can be in a commodity market. The limit for silver is 9,000 contracts. So, how did JPMorgan hold 40,550 contracts, which is 4.5 times the legal limit? They claimed an exemption. According to their filings, all those short positions were classified as hedging activity for their vault operations and banking services. Think about what that means. You're allowed to break the position limits if you claim you're hedging legitimate business risk. But if you're running vaults specifically to facilitate the manipulation, and then using those vault operations as justification for unlimited position sizing, you've created a perfectly circular scheme. It's like owning a casino, loading the dice, and then claiming your gambling is just hedging your casino business risk. The regulators bought this excuse for 14 years. But the evidence didn't stay hidden forever. In September 2020, JPMorgan agreed to pay $920 million to settle charges with the Department of Justice and the CFTC. The charge? Spoofing. That's the practice of placing large fake orders on the exchange to manipulate prices, then canceling those orders before execution. According to the DOJ investigation, JPMorgan traders placed thousands of spoofing orders in precious metals markets between 2008 and 2016, creating false impressions of supply and demand to move prices in their favor. $920 million. That's the largest precious metals manipulation fine in American history. And here's the part that should make your blood boil. JPMorgan didn't have to admit wrongdoing. They paid the fine, released a statement about improving their controls, and kept their massive short position completely intact. The underlying manipulation, the concentrated position that gave them market control, was never addressed. They paid what amounts to a cost of doing business and continued the same strategy for another 4 years. The CFTC data from November 2024 tells you exactly why this matters now, though. For the first time since 2008, JPMorgan's silver short position dropped below 15,000 contracts. That's not because they decided to voluntarily exit their winning strategy. That's because they're being forced to deliver physical metal to satisfy contracts. And each delivery is a forced closure they can't paper over anymore. The scheme worked for 14 years because the paper game never had to become a physical game. But at $59 per ounce with Basel III enforcement, the physical game is the only game left. Now, if you want to understand where this is heading, you need to know the story of what happened the last time someone tried to corner the physical silver market. March 1980, the Hunt brothers. Bunker Hunt and his brother Herbert accumulated 59 million ounces of physical silver between 1973 and 1980, driving the price from $6 per ounce all the way to $49.45. Adjusted for inflation, that's equivalent to $187 in today's money. The Hunt brothers' strategy was simple and devastating. Buy futures contracts, demand physical delivery, and squeeze the shorts who thought they could sell paper silver indefinitely. By early 1980, they had accumulated so much metal that COMEX faced a crisis. The exchange simply didn't have enough physical inventory to satisfy delivery demands if the Hunt brothers kept rolling their contracts forward and taking possession. The entire market structure was on the verge of collapse. So COMEX did what regulators always do when the powerful are about to lose. They changed the rules mid-game. On January 21, 1980, the exchange implemented what became known as Silver Rule 7. This emergency measure banned new long-only positions in silver futures. You could only enter the market if you were closing out an existing position or hedging. The purpose was explicit: stop the Hunt brothers from accumulating more and force them to liquidate. The effect was immediate. Silver crashed from $49 to below $11 in just 4 months. The Hunt brothers were bankrupted, the short sellers were saved. And the lesson was clear. You can't beat the exchange because the exchange will change the rules to protect itself. Fast forward to today, and the situation has one critical difference that makes all the historical parallels both terrifying and exciting. The current delivery pressure involves 862 million ounces of open interest across all COMEX silver contracts. That's 14 times larger than what the Hunt brothers accumulated. But here's the trap for the regulators. They can't just implement Silver Rules 7 version 2.0 because Basel III international banking regulations now supersede COMEX bylaws. Let me explain why this matters so much. Basel III is international banking law implemented across the United States, Europe, and major financial centers worldwide. It's not a COMEX rule that some exchange committee can vote to suspend during market stress. The requirement that banks hold physical backing for unallocated metals derivatives isn't something JPMorgan can lobby away or that regulators can waive during a crisis. Violating Basel III means violating international banking compliance standards, which triggers consequences far beyond just getting fined by the CFTC. So, you have a situation where the precedent says, change the rules and protect the shorts. But the regulatory structure says, you can't change these particular rules without triggering a global banking compliance crisis. The Hunt brothers were one family that could be bankrupted by rule changes. Today's delivery pressure comes from industrial users who need the metal for production, sovereign wealth funds protecting currency reserves, and thousands of retail investors who learned the lesson of 1980 and know the paper game is rigged. You can bankrupt one billionaire. You can't bankrupt the entire industrial supply chain without collapsing the economy. But here's the smoking gun evidence that tells you JPMorgan knows exactly how trapped they are. Their own SEC filings. Every quarter, publicly traded banks have to file 10 Q reports detailing their financial positions, including derivatives exposure. In Q3 2024, JPMorgan's precious metals derivatives book decreased by $14.7 billion. At the same time, their physical metal holdings increased by 2,100 tons, according to Vault inventory disclosures. Think about what those numbers mean. The bank that has held the largest short position in COMEX, silver for 14 years, is simultaneously closing out derivatives, positions, and accumulating physical metal. This is not normal portfolio rebalancing. This is institutional panic. They're not making this move because they suddenly believe in silver as an investment. They're making this move because they know the paper market is going to fail and they need physical metal to survive what's coming. And if you think I'm reading too much into their position changes, go read the risk management section of their most recent 10Q filing. There's a line buried in the legal disclaimers that says, and I'm paraphrasing here, physical delivery demands may exceed available inventory during periods of market stress. That's corporate lawyer language for, we might not be able to deliver what we sold. They're telling you the trap exists, right there in regulatory filings that they're legally required to publish. They're just betting that nobody reads the fine print. The Hunt brothers proved that a concentrated physical position could break the paper market. The 2020 settlement proved that JPMorgan manipulated silver prices for years. Basel III eliminated the escape routes that saved the shorts in 1980. And JPMorgan's own actions, closing paper shorts, buying physical metal, prove they see what's coming, and they're trying to get on the right side before the trap closes completely. This is not speculation. This is not theory. This is documented evidence from government reports, regulatory settlements, and corporate filings. The 14-year manipulation scheme didn't end because JPMorgan had a change of heart. It's ending because the mathematics of physical delivery under new banking regulations made the continuation impossible. They built the trap. They got caught in it. And now they're scrambling to escape before everyone else realizes the emperor has no silver. So here's the question that matters most to you. What happens next, and how high does silver actually go when this trap fully springs? The answer is pure mathematics, and the math is absolutely brutal for anyone on the short side of this trade. Let's start with the inventory numbers, because this is where the paper fantasy meets physical reality. As of December 2024, total COMEX registered silver inventory, that's the metal that's actually allocated and available for delivery, stands at 28.4 million ounces. There's another 186 million ounces sitting in what's called eligible inventory, which means it's in COMEX warehouses but not designated for delivery. Think of registered as ready to ship and eligible as in storage but spoken for. Now, here's where the mathematics becomes unavoidable. Total open interest across all COMEX silver contracts represents 862 million ounces of paper claims. That's 862 million ounces that contract holders have the legal right to demand as physical delivery. So, we have 28.4 million ounces available to deliver against 862 million ounces of promises. That's a ratio of roughly 30 to 1, 30 paper claims for every single physical ounce actually sitting in deliverable form. You might be thinking, but didn't you say that 95% of contracts historically settle in cash? You're exactly right. That's how this system survived for so long. The whole structure depends on that assumption holding true. But let's run a simple calculation that shows why $59 per ounce broke that assumption permanently. What happens if just 3.5% of open interest demands physical delivery instead of the historical 5%? 3.5% of 862 million ounces equals 30.2 million ounces. Available registered inventory equals 28.4 million ounces. We're already in deficit territory, and we haven't even reached the normal historical delivery rate yet. That's how thin the margin is. The system has no buffer left. And remember what I told you about December 2024? JPMorgan received delivery notices for 5.2 million ounces in that single month. If that delivery rate continues, and remember, this is the first month where silver held above $59, then at 5.2 million ounces per month, the entire registered inventory gets depleted in 5.4 months. We're looking at May 2025 as the mathematical endpoint where the deliverable silver simply runs out. But here's where it gets even more interesting, because that timeline assumes delivery rates stay constant. In reality, delivery demands accelerate as inventory drops. Why? Because once market participants realize that inventory is depleting faster than it can be replenished, the rational response is to demand delivery immediately before the vaults are empty. It's a bank run, except the bank is a vault, and the deposits are silver bars. If delivery rates increase to just 7 million ounces per month, which is entirely reasonable once panic sets in, you're looking at a March or April 2025 endpoint. That's 3 to 4 months from right now. And here's the beautiful trap within the trap. JPMorgan can't pull from eligible inventory to replenish registered without triggering the exact death spiral they're trying to avoid. Every ounce they move from eligible to registered is an ounce they're admitting isn't backing some other paper position, which triggers more delivery demands from contract holders who realize the backing isn't there. Now, you might be wondering whether new supply could rescue this situation. Maybe miners ramp up production, or maybe inventory flows in from other sources. Let's talk about why that's not going to happen, using data from the Silver Institute that tracks global supply and demand fundamentals. Industrial silver demand for 2025 is projected at 642 million ounces. Just the solar panel industry alone requires 247 million ounces for next year's production. That's a 49 million ounce increase from 2024 levels because solar capacity is expanding globally as countries race toward renewable energy targets. Then you have electric vehicles, which use 25 to 50 grams of silver per vehicle in various electrical components. With 17 million EVs projected for production in 2025, that's another 15 to 25 million ounces of new industrial demand that didn't exist 5 years ago. Total global mine supply for 2025 is projected at 843 million ounces, according to mining industry forecasts. So, if industrial demand is 642 million ounces and total supply is 843 million ounces, that leaves a surplus of 201 million ounces for investment demand, coinage, and yes, COMEX warehouse inventory. But here's the problem. That 201 million ounce surplus used to be 340 million ounces back in 2020. The surplus is shrinking every year as industrial demand grows, and that shrinking surplus was the buffer that allowed paper markets to function. More importantly, Industrial users are now paying premiums to secure supply directly from miners rather than competing in exchange markets. When First Majestic Silver can sell directly to a solar manufacturer at a $2 premium over COMEX prices with guaranteed delivery schedules, why would they feed metal into a warehouse system controlled by banks that have manipulated prices downward for years? The answer is they won't. And without miner cooperation in feeding COMEX warehouses, there's no mechanism to replenish inventory as it depletes. So the supply can't save them. The inventory math doesn't work, and industrial demand is removing the surplus that previously cushioned the paper market. That brings us to the final calculation. How high does silver go when these mathematical certainties become obvious to everyone? For this, we need to look at historical precedents of short squeeze dynamics in other markets. The Volkswagen short squeeze in October 2008 provides the clearest pattern. In that situation, Porsche secretly accumulated Volkswagen shares while a large short position existed. The squeeze happened in 3 distinct stages. Stage 1 was a gradual 300% price gain over 2 years as Porsche accumulated. Stage 2 was a pause and consolidation period where shorts attempted to cover. Stage 3 was a vertical spike of 380% in 48 hours when the market realized physical shares were exhausted and couldn't be borrowed. Silver has already completed Stage 1. From the 2020 low of $18 to the current $59 represents a 327% gain over roughly 4 years. We are entering Stage 2 right now. JPMorgan's forced deliveries in December represent their attempt to cover short positions before the situation becomes uncontrollable. Stage 3 triggers when registered inventory drops below 10 million ounces, which represents about a 10-week supply at current delivery rates. That's the point where the market realizes the metal is actually gone. Based on historical precious metal squeeze precedents and current supply-demand fundamentals, here are the price targets with their corresponding probabilities. Conservative scenario: $120 to $150 per ounce. That's based on the gold to silver ratio returning to its historical average of 40 to 1. With gold currently around $4,000, that math gives you silver at $100. The conservative estimate adds a 20 to 50% premium for supply tightness. Moderate scenario: $200 to $250 per ounce. This is equivalent to the 1980 peak price adjusted for inflation. Remember, silver hit $49.45 in 1980, which equals about $187 in today's money. The moderate scenario assumes we match that inflation-adjusted peak with an additional premium for the fact that industrial demand is far higher today than it was in 1980. Vertical spike scenario: $295 to $350 per ounce. This is what happens if industrial supply chains panic. Imagine you're a procurement manager at a major solar manufacturer with a billion-dollar production line that shuts down without silver delivery. At what price do you stop caring about cost and start panic buying whatever metal is available? $300 per ounce is cheap if the alternative is missing production quotas that cost your company 10 times that amount in lost revenue. When industrial users compete with investment demand and there's no available inventory, prices don't rise linearly, they spike vertically. The timeline for these scenarios is second quarter to third quarter 2025, somewhere between 6 and 9 months from right now. That timing is based on current delivery rates, inventory depletion mathematics, and the typical duration of Stage 2 consolidation in historical squeezes. If industrial panic buying accelerates the timeline, we could see the spike as early as April or May. If delivery demands slow temporarily as JPMorgan manages to delay or negotiate some settlements, it could extend to August or September. But the mathematical endpoint is the same regardless of minor timing variations. Now, I want to be very clear about what I'm saying and what I'm not saying. I'm not telling you to buy silver. I'm not giving you investment advice. I'm showing you the mathematics of a situation that is playing out in real time with publicly available data. The inventory numbers are published by COMEX. The delivery demands are documented in exchange reports. The industrial demand projections come from the Silver Institute. JPMorgan's position changes are in their SEC filings. This is not prediction. This is calculation based on verifiable information. What I am telling you is that you're watching a mathematical trap. Close in slow motion. JPMorgan engineered a 14-year scheme to control silver prices through paper manipulation. They accumulated a concentrated short position that was too big to hide and too big to close without moving markets. They built a system that worked perfectly as long as 95% of contracts settled in cash and nobody demanded physical delivery. They controlled the vaults, controlled the pricing, and made billions of dollars in trading profits by keeping silver artificially suppressed. But Basel III eliminated their escape routes by requiring physical backing for paper positions. $59 per ounce triggered delivery demands from miners, industrial users, and international arbitrage that drained inventory faster than it can be replenished. And now, they're being forced to deliver physical metal. They don't have to satisfy contracts they never thought would be called. Every ounce they deliver brings them closer to default. Every ounce they refuse to deliver proves the fraud and triggers more delivery demands. The math is simple. 30 paper claims for every physical ounce means only 3.5% of contract holders need to demand delivery to exhaust available inventory. At current delivery rates, that happens in 3 to 5 months. And historical squeeze patterns show that when physical scarcity becomes undeniable, prices don't rise gradually, they spike vertically. This is not a conspiracy theory. This is not speculation. This is mathematics. And the math says that the largest bank in America is trapped in a position where they promise to deliver almost 1 billion ounces of silver while holding less than 30 million ounces in available inventory. They can't win. They can't escape. And the clock is counting down. The calculation is simple. The endgame is inevitable. And it's already started. The only question left is, how high does silver go when everyone else figures out what the math has been screaming for months? Because at $59 per ounce, we're not at the end of this story. We're just getting started.